If you're watching this right now, I want you to imagine something for a second. A crisis so large, it doesn't start with a crash. It starts with a quiet shift in Japan, a single policy change, a bond move, a currency move. And suddenly, the global financial system begins to pull on a thread that connects to everything. Stocks, housing, pensions, tech, crypto, even your bank's stability. Because what Japan just triggered isn't a Japan problem, and it's a global liquidity problem. And if this chain reaction continues, many portfolios won't be down. They'll be forced into liquidation, not because investors panic, but because the system runs out of breathing room. And here's the most chilling part. The timeline is short. We're talking about 90 days, the window where margin, refinancing, and leverage collide. So today, on Financial Freedom Desk, we're breaking down exactly how Japan may have sparked what some analysts are calling a $20 trillion pressure event, why it matters to every investor on Earth, and what you should watch before markets realize what's happening. And trust me, most people still have no idea. Now, before we begin, if you value this kind of clear, real economic breakdown without hype, take 1 second to hit like and subscribe to Financial Freedom Desk. It helps the channel grow, and it tells the algorithm you want more news like this. Let's get into it. Japan has been the financial world's quiet giant for decades. It's not loud like the US. It doesn't dominate headlines like China, but it holds something more powerful than attention. It holds leverage. Japan is one of the largest holders of foreign assets on Earth. Its institutions, banks, insurers, pension funds own massive amounts of US Treasuries, European bonds, global equities, and corporate debt. And for years, Japan's role in global finance was predictable: ultra low interest rates, easy money, stable borrowing costs. That meant Japanese institutions could borrow cheaply in yen and then invest in higher yielding assets overseas. This is what markets call the carry trade, and it's been one of the biggest invisible engines driving global liquidity. Here's the simple version. When Japan keeps rates near zero, global investors borrow yen cheaply, convert it to dollars, and buy assets like US stocks, bonds, and credit products. That pushes prices up, that pushes yields down, that creates stability. And so Japan wasn't just a country, and Japan was a global funding source. Now, here's the problem. That funding source is shifting, and when the world's cheapest money gets more expensive, everything built on it starts to wobble. Japan has been trapped in a strange economic reality for decades. Low growth, low inflation, and central bank intervention. But recently, inflation has started to rise inside Japan. Wages have begun to move, and the Bank of Japan has started to step away slowly from its extreme support of the bond market. This is not just a policy adjustment, and this is like removing a pillar from a building that everyone assumed was permanent, because Japan has been holding down its yields artificially through bond buying programs. And when those supports loosen, yields rise. And when yields rise, Japanese investors have a new option. They don't need to chase returns abroad anymore. They can earn more at home. That might sound harmless, even healthy, but globally, it's terrifying. Because if Japan starts bringing money back home, that means global markets lose a major buyer. It means US bonds lose support. It means global credit spreads widen. It means equity valuations become vulnerable. And most importantly, it means the carry trade begins to unwind. Now let's talk about the phrase $20 trillion crisis, because that sounds dramatic, but it's not random. The scale of global leverage connected to Japan's funding environment is enormous. Think about this. Japanese institutions hold trillions in foreign assets. Global investors have built strategies around cheap yen funding. Derivatives and hedging markets amplify these positions. Bond markets, stock markets, and FX markets are all tied together. So when Japan shifts, it doesn't cause a small adjustment. It creates a liquidity wave, and liquidity is the true driver of markets. Not earnings, not headlines, not even fear. Liquidity, when liquidity rises, assets inflate. When liquidity disappears, assets collapse. That's why this is so dangerous, because Japan's move can tighten liquidity at the exact moment the world is already fragile. High debt levels, high interest rates, weak consumer purchasing power, overvalued assets, corporate refinancing pressure. So Japan doesn't need to cause a crash. Japan just needs to remove the cushion, and then gravity does the rest. Now let's break down the 90-day liquidation window, because this is where things get real. Markets don't usually crash because everyone suddenly changes their mind. They crash because the system forces selling. Forced selling happens when margin calls hit, collateral values drop, leverage becomes unsustainable, refinancing fails, credit lines tighten, and liquidity disappears. So why 90 days? Because in many leverage systems, there's a cycle of rolling positions, refinancing debt, resetting collateral, meeting margin requirements, and adjusting hedges. And when conditions shift fast, like yields rising, currency moving, and bond volatility increasing, those cycles become lethal. If your collateral loses value, your lender doesn't care about your long-term strategy. They care about risk today. They demand cash today. And if you don't have it, you sell what you can. That's liquidation, not opinion-based, not emotional, mechanical. Now imagine this happening at scale. A small group of funds unwind, bond yields spike, equities dip, volatility rises, then another wave of funds gets hit with margin calls. Markets don't usually crash because everyone suddenly changes their mind. They crash because the system forces selling. Forced selling happens when margin calls hit, collateral values drop, leverage becomes unsustainable, refinancing fails, credit lines tighten, and liquidity disappears. So why 90 days? Because in many leverage systems, there's a cycle of rolling positions, refinancing debt, resetting collateral, meeting margin requirements, and adjusting hedges. And when conditions shift fast, like yields rising, currency moving, and bond volatility increasing, those cycles become lethal. If your collateral loses value, your lender doesn't care about your long-term strategy. They care about risk today. They demand cash today. And if you don't have it, you sell what you can. That's liquidation, not opinion-based, not emotional. Then pension funds rebalance, and then insurers sell risk assets. Then banks tighten credit. Then a real economy slows. And this is how financial crises spread, not through one explosion, through a chain reaction. Now let's talk about why Japan is uniquely capable of triggering this. Because Japan's currency, the yen, has been weak, and the weaker the yen gets, the more pressure builds. Here's why. If you borrowed yen and bought US assets, you were winning twice. Higher yields in the US, plus a weak yen boosting returns when converted back. But if the yen strengthens suddenly, that trade reverses violently. The same investors who borrowed yen now rush to repay it. And that means they buy yen. Sell dollars, sell assets, reduce leverage. That's the carry trade unwind, and it can happen quickly because the carry trade isn't investors calmly repositioning. It's leverage, and leverage never unwinds politely. It snaps. So if Japan triggers yen strengthening and higher domestic yields, global investors don't just consider new allocations, they rush to the exit. And when everyone rushes at the same time, markets don't fall smoothly, they gap down. Now let's connect this to your portfolio, because you might be thinking, I'm not trading yen. I don't own Japanese bonds. So why does this matter? It matters because your portfolio is connected through the global financial plumbing. Your stocks depend on liquidity. Your bonds depend on stable demand. Your tech holdings depend on cheap financing. Your real estate depends on credit conditions. And when liquidity tightens, everything reprices, even safe assets. In fact, in the early stages of crises, even gold can dip, even quality stocks can drop, because the first wave isn't about value. It's about survival. The second wave is where value investors step in. But the first wave, it's forced selling, Now here's the 360-degree breakdown, because this is not just about stocks. Let's walk through the system. First, bonds. If Japan reduces purchases of foreign bonds or begins repatriation, U.S. yields rise. Higher yields mean higher borrowing costs, lower valuations, more refinancing stress. Second, currency. If yen strengthens, carry trades unwind. That creates global FX volatility. Third, credit. Credit spreads widen. Companies pay more to borrow. Defaults increase. Fourth, equities. Valuations compress, especially in growth stocks. Fifth, real economy. Businesses cut spending. Consumers pull back, unemployment risk rises, and this is why Japan matters. Japan sits at the intersection of global bonds, global FX, global leverage, global liquidity. Now let's address the uncomfortable question. Why are people not talking about this? Because the Japan story is boring to most audiences. It's not dramatic like a war headline. It's not emotional like inflation, prices at the store. It's technical, and technical stories don't trend until they break the market. And then suddenly everyone says, how did this happen? But the warning signs are always there. So let's talk about the warning signs you should watch in the next 90 days. Number one, Japanese bond yields. If yields continue rising, repatriation pressure increases. Number two, yen strength. If yen strengthens sharply, carry trade unwind risk increases. Number three, U.S. Treasury volatility. Watch for spikes in bond volatility indices. That's the heartbeat of stress. And number four, credit spreads. If corporate debt spreads widen, liquidity is tightening. Number five, bank funding stress. Many assets are priced as if rates will fall, inflation will ease, growth will stabilize, liquidity will return. But Japan moving in the opposite direction is a threat to that narrative, because Japan doesn't need to crash the US economy. It just needs to remove one support, and then the overvaluation problem becomes visible. Now let's be practical. What should investors do? I'm not here to tell you to panic, but I am here to tell you to be strategic. This is the time to reduce unnecessary leverage, increase liquidity buffers, review risk exposure, avoid overconcentration, understand correlation risk, because in a liquidity event, correlations go to 1, meaning everything falls together, and the investors who survive are not the ones who predicted the exact day. They're the ones who are positioned to endure volatility without being forced out. That's the real edge. Now, let me end with the most important idea. Japan didn't break the system. Japan exposed the system. A world addicted to cheap money cannot handle the withdrawals smoothly. And when the cheapest money source in the world changes, the entire global structure feels it. So if the next 90 days bring rising yields, currency shifts, and credit tightening, the liquidation wave won't be a theory, it will be a headline. And by then, it'll be too late to reposition calmly. If you found this breakdown valuable, comment below. Do you think Japan will trigger the next global liquidity crisis? Yes or no? And share this video with someone who still thinks global markets only move based on US news. This is Financial Freedom Desk, and we'll keep tracking the signals before the world is forced to see them.